Hey everybody, and welcome back to H Invests. Today we're talking about cost advantage, which is our first deep dive analysis on an economic moat in our series, How to Analyze Business Models. If you've been following the series, welcome back. If not, welcome. We're basically analyzing these economic moats to help you improve your analysis of business models and improve your analysis of investing so you can make better investment decisions. If you enjoy my content, I'd really appreciate a like. It's very much helping the channel grow. Comment if you have any questions or any thoughts, and subscribe so you don't miss any of my content in the near future. Okay, let's get into it. So an economic moat, I ran by this in my last video, but thought I'd just give a quick refresher. So an economic moat, historically moats were built as a protective barrier against entry to a castle, right? So to have water protecting the castle, and it would stop enemies from getting in and attacking the castle. In business, an economic moat is a competitive advantage that a company has that prevents those new entrants from coming in, those new entrants from attacking it and taking the market share. That's what we're looking at. We're looking at types of advantages businesses have, which basically avoid a situation of perfect competition, and they can kind of retain their market share in their relevant market. Okay, so what are cost advantages? Effectively, this is where a company is able to produce goods or services at a lower cost and more efficiently than their competitors. So, for example, company X is able to produce goods and services at a lower cost, right? This advantage can't be easily replicated by others. This is a really, really key point. Like, sure, anyone can have an advantage, and then, you know, it's the free market, right? Go steal an idea and boom, that's it. So you have to have some kind of competitive advantage which stops the business from just, you know, opening that idea up to the whole market. Company X is then able to sell goods or services at a lower cost than their competitors because of the efficiency that the economic moat is creating. And then this allows companies to gain market share, and it also prevents them from losing that market share. Okay, so where do these cost advantages come from? Examples being advantages in a business process, superior locations, scale, and also access to a unique asset. So, for example, advantages in a business process would just be a form of efficiency that's very unparalleled, with very, very good management, efficiency in production lines, etc., which give the business a competitive advantage. Scale, let's go through scale really quickly. So companies like United Health, they often have scale advantages where they have large amounts of fixed costs. So then if they're a large company, they can basically have higher margins and they can grow their business quicker because there's so many costs you have to pay for, right? But those costs don't vary with United Health's revenue. And since United Health is one of the biggest health providers in the US, then it effectively allows it to grow its business and keep its market share and effectively have really high margins because these costs are fixed. And then also access to unique assets. So we're going to go through this as a kind of a key example in the following slides, but that would be like some kind of mine that has an advantage of a unique commodity that it has that can effectively allow for a competitive advantage because the other businesses don't have access to that commodity. And that's the example we're going to go through now. So Kirkland Lake Gold, does this company have an economic moat? Let's analyze it together and let's find out. So, Kirkland Lake Gold, the first thing I wanted to do, which I think people should do because it's obviously very difficult to like independently analyze all the business models, is use quantitative factors as a shortcut. So some of the key quantitative metrics I mentioned in my last video in the series: return on capital employed, which is earnings before interest and tax, over all the capital employed, the equity that the shareholders have put in, and the debt that the bondholders have put in. What is the return that they're getting from that? And also the margins. So how quickly is, how much of that revenue is falling to earnings before interest and tax? How efficient are they? And also asset turnover is the third one that I put in this table. So that's effectively measuring how, of all of the assets the business has, how good are those assets at generating sales, right? And that's very important for people like gold miners because they're very asset heavy, right? All of the machinery that you need, like all of the like permits you need to go and mine there, it's a very asset heavy business where it's very capital intensive, where you have to have a lot of assets in order to effectively make the revenue. So here we go. You can see Kirkland Lake Gold, and it scores highest for all of these. You know, return on capital employed, almost double any others. EBIT margins of 60%. That's absolutely crazy. And also asset turnover is joint highest in the pack, along with Polymetal. So this just shows you that Kirkland Lake Gold has an incredibly efficient business model, and this might mean that there's an economic moat. So these quantitative metrics can be used as a shortcut to screen out companies that may have an economic moat. It's not, you know, it's not a certainty. It's just that we have used it as a shortcut, and now we need to do our proper analysis. So yeah, what if Kirkland's just had a good year? The filter was our shortcut for finding economic moats. Now it's time for some proper analysis. So step one, the way that I would do this first is check that they just didn't get lucky over that year and had some really, really good results. And two, you also want to find out the why. Like the quantitative metrics kind of tell you the what, but you also want to find out the whys and the hows to why this business model is so efficient. Okay, so step one, you know, take a look at the longer term quantitative picture. So you can see this time we've done exactly the same thing, but this time we're looking at return on capital employed, EBIT margin, and asset turnover over a 5-year period. And again, Kirkland scores very, very high. Return on capital employed, it smashed it at over 20%. EBIT margin, again, the highest of the group. In fact, almost the highest of the group after, what was it, Franco Nevada. And asset turnover, incredibly high as well. So you can see that Kirkland is still doing very, very well over a 5-year period. So the latest financial year we looked at was not just some kind of lucky streak, right? You can also see, which is great, the return on capital employed, EBIT margins, and asset turnover have all improved over the past 5 years, which may even indicate that Kirkland's economic moat is strengthening. So now we want to look at the why. What is it about the business model? Step two, analyze the business model. Effectively, what's going on with Kirkland here, and the thing you want to be kind of thinking about is what kind of economic moat around cost advantages do they have? Is there an advantage in the business process? Do they have a superior location? Do they have some kind of high level of fixed costs that then they can just scale up? Do they have access to a unique asset? Let's go and have a look. So with regards to Kirkland, the reason that we see such high returns on capital employed, such high margins, very efficient asset turnover, is because they mine really high grades of gold. So effectively what I mean by this is that when you're mining gold out of the ground, you have the rock that you effectively mine, which has some gold in it, but how much gold is actually in that rock per ton of rock? How much of it is really pure gold? And it turns out that Kirkland's mines have much higher grades of gold than the average, right? So Kirkland's gold mines 15 to 30 grams per ton. I believe down in Fosterville, they managed to get some 30 grade a ton, which is one of their mines down in Australia. But the world average is about 4 to 6. So if you think about it, for every ton of rock that you mine, there's much more gold than you can sell on an exchange. Like, because gold is such a high price and it's such a precious metal, the difference between 30 grams of gold per ton and 6 grams per ton is huge. And this is why you see the return on capital employed 3 to 7 times some of Kirkland's competitors, because they're only mining gold out about 5 grams per ton, right? And Kirkland is doing 20, 25, in some cases 30 grams per ton. And it makes it incredibly more efficient because they have the same costs of mining a ton of rock out of the ground, but they can sell that rock for so much more because it contains so much more gold. That's what it is. So this is a unique asset scale advantage, and that is why you see such high returns on Kirkland Lake Gold. The other thing you want to be looking at with these mining companies, not so much for gold, but if the commodity has a lower value to weight ratio, is what is the transportation cost, right? Because it costs a lot of money to transport commodities around. Like, how quick can they get to somebody that will buy that commodity off them? As I said, with gold, it doesn't matter so much, right? Because gold is trading for what, like $1,800 an ounce, right? And an ounce is a tiny amount of gold, so it doesn't matter so much. But if you had this like massive lump of like metal X, where like a ton of it, you could only sell it for say $1,000, the transportation costs matter hugely, because you're not going to make that much money if you are selling something that's very difficult to carry around and doesn't sell for that much, but you're having to drive a long way to go and sell it. So that's another thing I would look at. It doesn't apply for Kirkland so much because gold is a precious metal and that's what they mine. But these are kind of things you want to be looking at, right? Like Kirkland can sell the vast majority of its gold very locally. Like it's in Canada and it's in Australia. There's loads of refineries willing to accept that gold. If you were selling some commodity in a country where it was very, very difficult to sell it, you'd have to then transport that commodity a long way. And if it wasn't something that had such a high value to weight ratio as gold, you'd also have to watch out for the transportation costs, which mean that other miners who kind of mine these, who are very close to somewhere where they can sell it, they might have an economic moat over location advantage. So that's pretty much all I had to say. This is Kirkland Lake Gold. That's basically how cost advantage works. Again, you want to be looking at an efficient business process. You want to be looking at a geographical advantage. You want to be looking at a lot of fixed costs that the business can leverage and then kind of grow like that. Or you also looking at this unique asset, which for example Kirkland has, which is a very high grade of gold. I hope you guys enjoyed the video. Next up, we're going to be looking at Microsoft and switching costs, which is going to be very fun. Let me know your thoughts down below. And until next time, happy investing.